Hi, welcome to the International Tax and Transfer Pricing Basics and How to Lower Your Effective Tax Rate webinar. My name is Elizabeth Hazard, and I'm a director at BKD in the Transfer Pricing Group. With me is Sarah Savu, who's a senior manager in BKD's International Tax Services Group. Today, we're going to talk to you about the basics of international tax and transfer pricing with the goal of giving you some ideas about how to potentially lower your worldwide effective tax rate. So today's agenda is going to start with an overview of international tax and just thinking about how US businesses are taxed abroad, because it can be very different than what is done in the US. Then we'll move into transfer pricing and discussing principles of transfer pricing and ideally showing you how those principles can be used to lower your worldwide effective tax rate. And just, again, kind of thinking about how international tax and transfer pricing, while my background is quite different than Sarah's, they actually go hand in hand and help each other a lot. And so with that, I will pass the presentation over to Sarah.
Thank you, Elizabeth. Hi, everyone. My name is Sarah Savu. I'm a senior manager in our International Tax Services Group at BKD. I've been with BKD for about 11 years. I started my career in the domestic tax group and then joined the international tax group in 2014. These past 7 years of practicing international tax have been interesting, to say the least, perhaps exciting if you're a glutton for punishment. Just kidding. There's been a lot of learning, unlearning, taking fundamental concepts, flipping them on their heads, and then relearning due to the legislative overhauls of international taxation. And given that this is a basic course in transfer pricing with a focus on potential strategies to lower your worldwide effective tax rate, it would be extremely difficult to just jump into the transfer pricing basics without a high-level understanding of how businesses with cross-border transactions are taxed. So we will be doing a crash course in the basics of international taxation. And as I previously mentioned, there has been a great deal of changes to the US's approach to international taxation. So I will be referencing pre-tax reform, which are the years leading up to the Tax Cuts and Jobs Act of 2017, tax reform, which affects tax years beginning on or after January 1st, 2018, to current. And finally, I will be briefly highlighting part of the draft legislation that was released by the Senate Committee on August 25th of this year to overhaul the international tax provisions of TCJA. So we need to reel it back into the basics of international taxation. So I'm going to briefly discuss two types of taxing regimes that countries may decide to implement when resident companies earn income in foreign jurisdictions. One taxing regime is a territorial system. A territorial taxing regime is implemented by a country where the country will only tax income earned in that country. Another taxing regime is an extraterritorial or a worldwide system. A worldwide taxing regime implemented by a country permits the home country to tax your worldwide income. Historically, the US used a worldwide taxing regime where all US source income, as well as foreign source income, was subject to tax in the US. However, worldwide systems typically allow resident corporations to claim foreign tax credits for taxes paid in foreign jurisdictions in order to avoid double taxation. Worldwide systems also typically allow for the deferral of tax on profits earned by foreign corporations until those profits are repatriated to the domestic shareholder in the form of a dividend. So currently, the US is working under a hybrid taxing regime between both a territorial and a worldwide taxing system, where tax reform essentially eliminated the taxation of repatriated dividends for corporations, but it really expanded the taxation of income earned within certain foreign corporations. The hybrid approach tries to tackle the issue of income shifting in a pure territorial system and also reducing the competitive disadvantages for resident companies in a country that implements a worldwide taxing regime. So making sure you have the right structure in place for your global operations is extremely important in managing your worldwide effective tax rate. And in order to develop strategies to help manage this, you must understand how certain entities are treated for US tax purposes. Two basic concepts are flow-through and deferral. Deferral with a caveat. Flow-through earnings are foreign income and losses that are taxable in the US to the shareholders of the foreign business in the year recognized. Owners may typically claim a foreign tax credit for the foreign taxes paid in the local country. Typical flow-through structures are foreign branches, foreign disregarded entities, and foreign partnerships. The income is usually taxed at ordinary rates and can be beneficial when foreign taxes are high relative to the US tax on the income. And so I caveated the concept of deferral because the deferral strategy looks very different pre-TCJA as it does post-TCJA. So prior to tax reform, earnings from foreign corporations were not taxed to the US taxpayer until they were remitted in the form of a dividend. So in other words, US income taxes on foreign earnings were deferred until repatriated. So this concept still generally stands true for shareholders with small ownership interests, which typically means less than 10%, if the foreign corporation is not a controlled foreign corporation, which we call a CFC, and if the foreign corporation is not considered a passive foreign investment company, which we call a PFIC. PFICs have their own anti-deferral rules that we are not going to discuss today, or we could be here for another 4 hours. So a CFC is any foreign corporation in which more than 50% of the total combined voting power of all classes of stock entitled to vote is owned directly, indirectly, or constructively by US shareholders on any day during the taxable year of the foreign corporation, or if more than 50% of the total value of the stock is owned directly, indirectly, or constructively by US shareholders on any day during the taxable year of the corporation. A US shareholder is defined as a US person who owns directly, indirectly, or constructively 10% or more of the total combined voting power of stock entitled to vote, or 10% or more of the total value of all classes of stock entitled to vote in a foreign corporation. And so there are special rules in determining whether a foreign corporation is a CFC or not. Well, there are other special rules in determining whether a foreign corporation is a CFC or not, specifically when it comes to insurance income and the constructive ownership principles. So I highly recommend you take extra care in determining whether a foreign corporation is considered a CFC or not, because the consequences of owning a CFC create extremely complex reporting requirements and subject the US taxpayer to anti-abuse regimes that accelerate the recognition of certain earnings in a CFC, such as the Subpart F rules and the GILTI rules. So I'm going to touch on these very lightly for now. In general, the Subpart F rules were enacted to discourage companies from setting up foreign corporations in tax haven countries to minimize their US tax liability. Profits were being shifted from US companies to these offshore subsidiaries with little to no substance and where the local country has no income tax or extremely low rates. So the most common type of Subpart F income that we typically see are foreign-based company income and insurance income. And the GILTI rules were enacted as a part of tax reform with the intent to eliminate the incentive for generating profits in foreign countries and then keeping the earnings outside the US by reinvesting in foreign operations. And so to eliminate the barrier prospectively, IRC Section 245, also known as the dividends received deduction, was also enacted during tax reform. It provides a participation exemption for dividends from foreign subsidiaries, but this deduction is only available to domestic C corporations. So with the participation exemption, Congress realized this would allow companies to generate profits in foreign jurisdictions and repatriate the earnings without US tax. So they developed this new concept called Global Intangible Low Taxed Income, or GILTI. So the concept of GILTI is that excess earnings in a controlled foreign corporation or a CFC, are deemed distributed to US shareholders similar to Subpart F income. The definition of excess earnings is a little complicated, but the general concept is to allow CFCs to earn a 10% rate of return on its qualified business asset investment, which is essentially specified tangible property used in a trade or business and subject to a depreciation deduction. So the earnings in excess of that would be deemed distributed and taxable to the US shareholder in the year earned. A domestic corporate shareholders can claim a deduction equal to the lesser of 50% of GILTI or taxable income. And with the corporate rate currently at 21%, the net effective tax rate on GILTI is 10.5%, which is 50% of 21%, assuming that the domestic corporation is otherwise in a profitable situation. So corporate shareholders are also permitted to claim a foreign tax credit for foreign taxes paid on GILTI. However, FTC is limited to 80% of the foreign taxes paid. So while GILTI is intended to be a disincentive for corporations to generate profits overseas, there's not a net cost to doing so as long as the foreign taxes available for credit are at least 13.125%, which we will slightly discuss on a later slide. So as I mentioned previously, a worldwide taxing regime typically allows for foreign tax credits on foreign source income to avoid double taxation. And since the US implemented a hybrid approach to international taxation, foreign tax credits are still an extremely important aspect of minimizing your global effective tax rate. So what taxes are credible in the US? Credible taxes must be a tax on income, war profits, or excess profits tax. This is collectively referred to as income taxes. Income taxes paid to foreign cities or provinces qualify for the foreign tax credit. Like for example, Canada's provincial tax is a credible tax in the US. In addition, income taxes paid to US possessions are considered foreign taxes for foreign tax credit purposes, like including Puerto Rico, the US Virgin Islands, Guam, etc. However, an income tax must be a final tax. So if the tax is recoverable, say by filing a tax return in the local jurisdiction, the tax is not credible in the US. So even if you do not make the effort to recover the tax, it's still not considered a credible tax. The IRS does not want to foot the bill for a company who does not want to put the effort to recover taxes that they overpaid in a foreign jurisdiction. So who can claim a foreign tax credit? It is not just limited to corporations. US citizens, domestic corporations, non-resident aliens, partners in partnerships, and beneficiaries of estates are all entitled to take a foreign tax credit, subject to limitation. Each taxpayer can elect to credit foreign taxes paid or deduct the foreign taxes as an expense, but you cannot do both in the same year. The election is made by simply doing one or the other. The taxes should be credited in the year paid or accrued, again, subject to limitation. Foreign tax credits can be carried back 1 year or carried forward 10 years, except foreign taxes attributable to GILTI income cannot be carried back or forward. And so, as I previously mentioned, the foreign tax credit is subject to limitation. I am sensitive to emphasizing this because the last time I discussed foreign tax credits in a presentation, I received a comment that said, it's limited, and I thought I emphasized that, but I will now be reiterating it. The foreign tax credit is limited to the US tax paid on foreign source income. The high-level calculation reads as pre-credit US tax multiplied by foreign source taxable income as the numerator and worldwide taxable income as the denominator. There are very specific rules to allocating and apportioning certain deductions to foreign source income that I will not be covering today, so I highly recommend you visit those rules when doing a foreign tax credit calculation. A foreign source income is separated into different baskets. These baskets were expanded under tax reform to include foreign branch and a GILTI basket. Foreign taxes earned on each type of income can only be credited against that specific type of income. So for example, foreign taxes paid on passive income cannot be credited against your GILTI inclusion. And there's some recapture rules based on domestic and foreign activities. So if a company has overall foreign losses, in a year there's foreign income, the income will be recaptured and converted to domestic source income, and this will reduce your foreign tax credit limitation. And then conversely, if a company has overall domestic losses, in a year there is domestic income, the income may be recaptured and converted to foreign source income, increasing your foreign tax credit limitation. Okay, so as I discussed previously, so many changes in the legislature regarding international tax. We just had tax reform in 2017. And on August 25th, 2021, the Senate Finance Committee released draft legislation to kind of overhaul the international tax provisions of TCJA. And what came out of it really is that the key provisions were retained but modified. And I'm going to run through some of the changes that will affect the topics that I discussed in this presentation. So they're changing GILTI to now kind of be referred to as global inclusion of low tax income instead of global intangible low tax income. They're going to eliminate the deemed tangible income return and qualified business asset investment from the GILTI calculation. And to be honest, that calculation was a huge pain. Like, I understand that it might increase your GILTI inclusion, but to be honest, that's kind of a relief for tax practitioners, I would say. US shareholders would include in gross income CSC tested income in lieu of the global intangible low taxed income. Eliminating QBI discourages taxpayers from owning depreciable assets abroad. GILTI will be calculated on a country-by-country basis and automatically exclude high tax tested income from the calculation. So losses incurred in one country cannot offset income earned in another country. Currently, as the law stands, we're allowed to aggregate the tested income from CFCs in different jurisdictions. So a loss in one country was able to offset income in another country, but with the draft legislation, they are sticking with a country-by-country calculation. And only tested income that is not high tax tested income would be subject to US tax under GILTI. This income would remain eligible for the 250 deduction and the GILTI foreign tax credit. Changes to the GILTI foreign tax credit haircut are still under consideration. So currently we can only deduct 80 or credit 80% of the foreign taxes paid on the GILTI income, and they're considering adjusting that, but they haven't said what they propose to be the new rate. And with Subpart F income, they're also considering a haircut for the foreign tax credits similar to GILTI. The amount of this haircut is still under consideration. They haven't said what the final rate would be, and they would also conform high tax sub F income to the treatment of the proposed GILTI high tax tested income. And then finally, foreign tax credits, they would extend these high tax rules to foreign branch income with a foreign tax credit haircut to potentially apply. And we didn't discuss this in any detail, but research and experimental expenses and stewardship expenses would be treated as 100% allocable to US source income if attributable to US activities. So we will be keeping a close eye on this legislation to see what actually gets enacted. And as of the date of this recording, this draft legislature that was released on 8/25 is all we have to go off of. So by the time that we are meeting in October, things could drastically change. And so now I am going to turn it over to Elizabeth to give you the rundown of the basics of transfer pricing.
Thanks, Sarah, for all the international tax goodies that you presented at the beginning. The proposed changes that you mentioned on this previous slide, it's just incredible to see all the things that they want to either undo or redo, and just, you know, it's 2017 all over again, or it could be, you know, everything has to pass and all the regulations have to be drafted, but it's just a lot of changes.
Yes, and the only good thing is it puts everyone on the same playing field. We're all learning it together, whether you just started practicing tax or you've been in this career for years. These big changes to the legislature just kind of puts us all on the same page, and we're all learning it together.
Yeah, that's a great point. Okay. So, you know, Sarah gave us an overview of international tax, and I mean, I think we can all see that there's quite a bit of complexity to it. So having someone that is skilled in that area is a good person to have on your team. So thinking about lowering your effective tax rate, this is really where transfer pricing comes into play, because transfer pricing can be used from a prospective approach or a documentation or a defensive approach. So let's first learn about transfer pricing, and then we'll kind of go into how to use it for more offensive or prospective planning. So transfer pricing really is talking about, so it's the subject of what is the appropriate compensation for intercompany transactions. And intercompany transactions are generally related parties, meaning that there's some kind of common ownership. And the types of intercompany transactions really could be anything. There's no really excluded type of intercompany transaction that wouldn't have a transfer price. So basically, anytime there's intercompany goods that are sold, or goods that are sold between companies, or services that are provided between companies, or IP that is transferred or allowed to be utilized between entities, all within the same group, again, usually shared ownership group. These are all, these are situations when transfer pricing comes into play. And I think it's important to note too that in the US definition of what consists like a controlled party or related party, it actually doesn't even have to have some kind of ownership control. It could be even like management related. So maybe you have the same president for two companies and they interact and sell. Well, that actually could be a really good situation where transfer pricing needs to be thought of, and a proper transfer price be developed and documented. So typically, my clients are international companies. And that's in part because the world has all these different tax rates, even though there's this talk of global minimum tax, and we'll talk about that very briefly at the end. But there's all these different tax rates, and many countries change their tax rates every few years. The US has done that, especially most recently with TCJA, lowering the corporate income tax to 21%. The UK, I feel like, is changing their tax rate about every 2 years, just looking at their budgeting needs. And so countries really do evaluate the corporate income tax. So it's something that transfer pricing can be advantageous to you, or you can make it advantageous to you, I should say. So when we're thinking about international companies that have all these entities abroad, or maybe it's not a lot, but just one or two, you have different tax rates, and therefore you have different tax authorities. And as you can imagine, each tax authority wants to make sure they're getting their fair share of the profit pie. And that's essentially what a transfer pricing document or analysis tries to prove out, or to determine what is the appropriate fair share. And the IRS, among other taxing authorities, they do have the legal authority to adjust your income if they think your transfer prices are wrong. So you're selling a widget from your US manufacturer to your UK distributor, and you're selling it for $5 a piece. Well, if the US thinks, we think that transfer price is too low and you should be selling it to the UK entity related party for $10 a piece, they can do that, and that's part of the whole IRS audit process and doing an adjustment as part of that audit process. So, kind of continuing on that idea of each tax authority wanting their fair share of the profit pie, that basically brings us to the arm's length standard. And that is the standard that pretty much every tax authority in the world, except Brazil, follows. So the idea of the arm's length standard is to treat the related parties as if they are not related, or as if they're unrelated. So really, you're trying to demonstrate to the tax authority with the arm's length standard that there's no funny business, there's no advantages that you're giving to in the example I just gave, to your UK distributor because they're a related party. You're all part of the same corporate organization. And what you're trying to demonstrate is that these two related parties that really are interacting as if they're third parties. Okay. Now, Brazil takes a more formulaic approach where you're calculating formulas based on the type of intercompany transaction that's going on, and frankly, it can just get a little messy. And that's why whenever we have our clients that have Brazilian tax needs, especially transfer pricing needs, we refer them to some of our contacts down in Brazil. But the arm's length standard really is the basis for all transfer pricing documentation. So I want to give some examples of intercompany transactions to help you think about, well, does my organization actually have any intercompany transactions, and therefore is there a transfer pricing need? So the first type, I just put up various types of sale of tangible goods. So in this case, we have a US manufacturing company. They're selling to their German distribution company. So in this case, they're most likely finished goods that they're selling from the US to Germany. And Germany is going to sell to third-party customers, whether it's in Germany or Europe or all across the globe. That doesn't really make a difference in the transfer price. What we're really concerned about is the payment that the German distribution company pays to its related US manufacturing company. And that's what a transfer pricing analysis determines. What is that appropriate payment? Now, as I said, the example there shows, basically the sale of finished goods. We can also look at the sale of raw materials or intermediate goods / components. That's another common type of intercompany transaction. As well as like purchasing commissions or purchasing agent services. That's also something to think about that has to deal with tangible goods. And last but not least, you have the idea of this transfer production machinery. That's another thing that needs to be analyzed. So using the entities that are up on the screen, XYZ US wants to send some tool and die to XYZ Germany because Germany is going to start doing some of its own manufacturing. Well, the US can't really just give that equipment to Germany. There has to be some kind of price that they're paying for it. Because in a third party to third party situation, one third party is just not going to give valuable tool and die equipment to another third party, like they're for free. They're going to expect some kind of compensation, and that compensation is what a transfer pricing analysis would determine. Okay, then another type of intercompany transaction that we look at are management services and other services, but management services is by far the most common type of intercompany services transaction our group analyzes. So in the depiction below, we have a US headquarters that is providing management services to its UK, Canadian, and Australian subsidiaries. So in a third party to third party situation, a US company would not just provide services for free to third parties in the UK, Canada, and Australia. There's going to be some kind of compensation that they would expect. And so in this case, we have the idea of the subsidiaries reimbursing the headquarters at cost, or most often with the cost plus, so that there's some kind of profit element associated with the provision of services. Now, the US does have a safe harbor for low value management services. And there's a revenue procedure that lists 101 low value management type services that can be charged at cost. And it also gives you an idea of what they're meaning when they say low value as well. So even if a particular service you're providing isn't on that revenue procedure, you still have an idea, again, oh yes, it is low value, or it doesn't really fit into this category. It should be considered high value and therefore be charged with a cost plus. So the US is different from other countries in that it does have this safe harbor, allowing some services to be charged at cost. It does, kind of staying on the safe harbor note, there is also a list, not of 101 services, but of approximately 8 services or functionalities, really, that must be charged with markup. So if, in this case, let's say the US providing financing services, or like intercompany loans or something, or reinsurance services, or manufacturing services, or sales services. These are things that are on the list of services that have to be charged at a cost plus. And so it's important to note that list, really both lists, to see how you want your transfer pricing to look. And even if something is on the safe harbor list where it could be charged out at cost, it may not be in the best interest for your company to do so. Maybe it would be better to add a profit element to the service charge in an effort to bring more money back to the US, and that could be for various reasons. Other types of services that we also look at are technical services, or like contract R&D services, contract manufacturing services, and also what we call the DEMPI functions. So DEMPI means development, enhancement, maintenance, protection, exploitation. And it's those 5 types of services, DEMPI services or DEMPI functions, is what really, as of now, and again, things could change in the future because tax laws are always being rewritten. But as of now, these DEMPI functions are really what are the profit drivers according to the tax authorities. Like that's what the high value stuff is. And so whatever entity is paying for those services and incurring the risks associated with those services, that is the true economic owner of the IP. And so in this case, with this example, if the US head office wanted to centralize all the IP ownership in the US, but let's say Canada was providing some contract R&D services, or they were providing R&D services, they would want to do that on a contract basis for the US. So therefore, the US is paying for the development of the product and therefore can maintain its economic ownership of the end product that's being developed. So basically any type of services that is being provided from one entity to another would classify as a type of intercompany transaction meeting the transfer price. The last example I want to give about an intercompany transaction is IP, because kind of going back to what I just said about DEMPI functions, development, enhancement, maintenance, protection, and exploitation, IP is very important. It's really being seen currently as the value driver of, essentially like why profits are where they are. So, if an IP or if IP is valuable, that's where the profits really should be accruing. It just needs to be, valuable to the company and a differentiator of it in the marketplace. So, sometimes definitely like patents and trademarks are important, but so are customer lists and, trade secrets. So if we think about like Coca-Cola's recipe for original Coca-Cola, that doesn't have a patent because in 30 years it would expire and then anyone could be making Coca-Cola. And the Coca-Cola company just doesn't want that. So they don't patent their, they don't patent their formula, they would rather keep it a trade secret. So, when we're thinking about IP, again, the entity that's owning the IP is the one that's paying for all the DEMPI functions. And ideally, your economic ownership should match your legal ownership. So if you were to, want to file for a patent for some IP that you've developed, you would also, ideally, you're going to have the entity that owns that patent be the same one that is the economic owner and paying for all the DEMPI functions that are going on. So, I just wanted to list some basic or common types of IP. Again, it does not have to be registered, it just has to be valuable to the company. Okay, so for the US, the transfer pricing documentations requirements are listed in the Treasury regulations. There's 10 different requirements that are need to be met when the IRS asks for your transfer pricing documentation. And so it's generally included in a report. So that's what my team and we prepare. Generally, we prepare like a report that outlines the company, the intercompany transaction, the functions being performed by which entities, what methodology we're going to select, and then the economic analysis that proves out what the transfer pricing is. Now, when we're thinking about methodologies, the US does have its own set of methodologies, and they have different sets for transactions related to tangible goods, intangible goods, and intercompany services. The OECD, or the Organization for Economic Cooperation and Development, also has issued a set of transfer pricing guidelines. And again, pretty much every other developed country, or pretty much any other country that has The tax authority, except for Brazil, follows the OECD's transfer pricing guidelines. Now, these methodologies, they're called different things than what the US calls their methodologies. So you kind of have to like do an alignment when you look at something from a US and an OECD perspective. But the principles of each of the methodologies are generally pretty similar. The OECD transfer pricing guidelines are really only applicable, well, they're applicable to all transactions, but they only have one set of methodologies, whereas the US has three different sets. Now, both companies, or I'm sorry, both organizations, being the Treasury, the US Treasury or IRS, and the OECD, they do allow for unspecified methodologies, which means if you can think of a way to analyze an intercompany transaction better than any of the other methodologies that are prescribed by those two organizations, you're allowed to use that, okay? You have to prove out why it's the best and why the other ones don't work, but really, you can use your own methodology that you create yourself. So it's not commonly done, but I've done it more than once in my career to create a specific methodology for a client to meet its needs, usually because the intercompany transaction is fairly unique. So now that we understand transfer pricing, the arm's length standard, and the documentation requirements, let's talk about how transfer pricing and international tax, they relate to each other. So let's pretend that here you have a foreign parent company that is manufacturing goods and it's selling to its US subsidiary, and the US subsidiary is going to distribute these goods. So Ireland sells to the US the goods for $150 or euros. They have their costs, they have their SG&A, they have profit, and with a 12.5% rate, they're paying $7.5 or euros in tax to the Irish Revenue Commissioner. And Ireland is happy about this because they're looking at the IRS and saying, oh, you only get $2.1 of tax revenue. So we're winning. So you can see Ireland's happy, the IRS is not so much. Now what happens if we change that transfer price? So in this example, we lower the transfer price. So we say Ireland is only going to sell $100 worth of goods to the US, but the US's sales still remain the same at $200. This changes the profit, the profitability of each entity, and therefore the Irish Revenue Commissioner is only getting $1.25 of tax, whereas the IRS is really winning because it went from $2.1 of tax to $12.6 of tax. So you can see, like, it definitely has the happy emoji going on.
Yes, and you can see in this example, because most of the profits were recognized in the US because the transfer price was much lower than the previous example, the worldwide effective tax rate is closer to 20% because most of the profits were recognized in the US at a 21% rate. As compared to the prior slide, the worldwide effective tax rate was closer to 14% because the transfer price on these related party sales was much higher, and so more profit was recognized in Ireland, making a worldwide effective tax rate on this transaction closer to 14%.
Yeah, so it really is, it's a pretty simple example, but as Sarah is saying, this $50 of change in the transfer price really affects your effective tax rate or your ETR. And so if you're trying to lower your tax rate, you need to be thinking about these things. How does a change in transfer price work? how is it going to affect my effective tax rate? And so, there are various ways to lower your effective tax rate. I mean, I think the first thing is to make sure all of the intercompany transactions are actually, there's some kind of compensation for. You're not just providing management services for free, or you're not just letting your subsidiaries use your trademark, especially if it's like a consumer brand, that trademark's very valuable. So, is there an opportunity to create an intercompany transaction that would potentially move profits from a high tax jurisdiction to a lower tax jurisdiction?
You also want to be, sorry, Elizabeth, in the example of a license fee, like a royalty, you also want to be cognizant about the country's withholding tax rules, because that would add into your overall effective tax rate.
Yeah, and I think, Sarah, I love your opinion. I think withholding taxes is probably most, with intercompany transactions and intercompany license fees or royalties in particular, that's where you see by far the most of withholding taxes. That's generally when it's incurred. So other ways, especially if you're like a US headquarter company going with subsidiaries abroad, if those subsidiaries really are just distributors, that's really their only function, perhaps thinking about making them limited risk distributors, because kind of the idea of risk equals reward, if you're limiting their risk, you're limiting their reward. And so generally they have a fixed operating margin, and that means, your German limited risk distributor, they get their fixed operating margin, and all that residual profit is going to go to the US, which does, as of now, has a lower tax rate than Germany. Also is moving IP to lower tax rate jurisdictions. You most commonly hear about this with Ireland. That definitely was the most popular place to put IP for a long time, especially in the tech field. I mean, now I will say, anytime you're moving IP, going back to what I was talking about with licenses, it's just very, it can be very controversial with tax authorities, or just heavily scrutinized. So if you ever do want to talk about moving IP from a lower tax to a lower tax rate jurisdiction, or even if it's higher, like anytime you're moving IP, you can almost always expect a lot of scrutiny from the tax authority that you're moving the IP away from. And you really want to make sure everything is very well documented. But, the idea that profits follow where the IP is, if you move your IP, then ideally you're moving your profits with it. And so that's why it's common to move it to a lower tax rate, such as Ireland.
And my comment here would be to contact your tax advisor if you are considering doing this. Contact your transfer pricing experts, because this usually creates a taxable event. You need to get valuation, you need to know the cost of the IP, and just it can be very complex and highly scrutinized. So be sure, if this is something you're considering, to get in touch with your tax advisors to help you walk you through what this would look like.
Yeah, and always do it. I mean, I won't say always, but it's always best if you can do it the earlier stage in the IP life, or like when it's just newly developed, before it has a lot of value to it, because the things that Sarah's mentioning, the valuation, it's going to make everything lower. So that's just, again, if you ever think about doing this, please do it sooner than later, because it just gets more and more expensive the later you let it go. Okay. And then thinking about what Sarah was talking earlier about potential changes that were issued on 8/25 from the Senate Finance Committee, and really there have been a couple drafts that have gone out. The Senate Finance Committee that Sarah mentioned is the most recent. Every draft is a little different, especially like if you have Congress proposing a draft versus the Senate. So there's also been proposed changes to BEAT and also this idea of SHIELD, and that's not necessarily really a tax, but like a disallowance of deductions. And these are things that have been proposed in the Senate Finance Committee that Sarah talked about earlier, that was issued on August 25th. And there's been a few drafts, like maybe BEAT goes away and SHIELD replaces it, or maybe they work simultaneously, but BEAT is base erosion anti-abuse tax. And that's for companies with an average revenue of $500 million. So your company may not be having to pay BEAT, which is good. It's usually for foreign-owned companies. That's generally when it applies. And this idea of SHIELD kind of relates to the idea of global minimum taxation, which you've probably also heard about in the news on occasion. And the US, with the current administration, have really backed the idea of a global minimum tax. And the idea of SHIELD is to disallow deductions that would go to, that are associated with lower tax jurisdictions. And there's some detail about changing BEAT. There's almost no detail on how SHIELD would exactly be implemented. And thinking about, some people want to replace BEAT with SHIELD. Well, does then only apply to companies over $500 million, or does it apply to everyone? So there's just a lot of unknowns, but I would say one theme is of the current proposed tax changes is that tax planning is going to be diminished, right? I should say international tax planning. They're trying to kind of take away some of the fun things that we can do, and that's really almost like a worldwide phenomenon too, just from what other countries are doing and what the EU is doing as a collective whole, and frankly, just the idea of a global minimum tax. So, Sarah, do you want to make any comments on BEAT and SHIELD, or you're just waiting for more details?
I'm basically waiting for more details. So from what I read in the Green Book in April, that's I think when they introduced SHIELD. Then with the draft legislature that came out in August, they're keeping BEAT and just taking concepts from SHIELD. So I guess we're on the edge of our seats to see what the final legislature comes out to be.
Yeah, and we're recording this in early September, so when we view this again in October, there could be a lot more detail, or there could be a lot more changes, and we'll just wait and see. So with that, we'll move on to the Q&A session of this webinar, and we thank you very much for your time.
Thank you.